Welcome to the deep dive. Today, we're really getting into something practical, something crucial actually, starting your investment journey. We've got this great source document, the Gulu book on Start Your Investment Journey, and our plan to pull out the key stuff so you can get smart about personal finance fast without all the overwhelm.
Exactly. We'll break down the basics, what saving and investing really are, why starting is so vital, and how to handle those big money decisions at different points in your life.
Okay, let's jump right in then. People often mix up saving and investing. Our source makes a point of separating them right at the start. What's the core difference there?
Right. So savings. That's just the cash you have left over after paying your bills. It's liquid, usually sits in a bank account. Investing, though, that's different. It's actively using that saved money. Buying assets, stocks, bonds, whatever, hoping for a return. Think interest, dividends, or, the asset growing in value. Savings accounts give you a tiny bit of interest, sure, but investing is really about building wealth.
Okay, building wealth. But why is that so important? Especially, thinking about Amit from the guide, the 26-year-old who wants to live life now.
Well, you invest to hit those big future goals. Things like retirement, paying for your kids' education, having that emergency cushion. And here's the thing. You can't just do what your parents or grandparents did. Inflation is much higher now. The goalposts have moved.
That makes sense. So, given that, the guide really pushes the timing aspect. Is there like a perfect age to start?
Well, Warren Buffett said he started at 11 and felt like he'd wasted his life before that. But yeah, the Gulu book is clear. Start as soon as you start earning. Why? Compounding. It's like magic. Your money earns returns, and then those returns start earning their own returns. Time is your biggest ally here.
The guide has a really powerful example in this, right? Raj starts at 22, putting in 5,000 rupees a month. Amruta starts at 30, but invests double that 10,000 a month. Both get 12% until age 50. What happens?
It's pretty eye-opening. Raj, even though he invested less each month, ends up with around 1.36 crore rupees. Amrita, despite investing more monthly, only gets to about 98.92 lakhs.
Wow.
Yeah, that difference. Over 37 lakhs. That's the cost of waiting for Amrita. Raj just had 8 extra years for compounding to work its magic. Starting early is huge.
That cost of waiting is just staggering. Really drives the point home. Okay, another big factor, inflation. The guide calls it a silent wealth eroder. How exactly does it mess with our financial plans?
It just shrinks what your money can buy over time. The example they use is Mr. Engel planning 10 lakhs for his daughter's college. With 10% inflation, in just 12 years, that same education could cost nearly 31.5 lakhs.
Oof.
Right. So the key takeaway is your investments absolutely must aim to beat inflation. Otherwise, you're actually losing value.
Which logically leads us to asset allocation. Can you unpack that a bit? Why is it so important for a stable portfolio?
Sure. Asset allocation is basically just spreading your money across different types of investments. Think equity, which is stocks, debt, like bonds, maybe gold, real estate, and so on. Different assets behave differently depending on the economy. So diversification means if one area tanks, it doesn't wreck your whole plan. It really depends on your risk profile and how long you're investing for.
Okay, and risk profile. The Gulu book mentions risk appetite versus risk tolerance. They sound similar, but aren't.
Correct. They can be quite different. Risk appetite is how much risk you're comfortable taking, emotionally willing to accept. Risk tolerance is about how much risk your finances can actually withstand without derailing your essential goals.
I see. Willing versus able.
Exactly. And that your actual profile age, income stability, dependence, that's what should really guide how you allocate your assets, not just how brave you feel.
That's a really important distinction. Okay, let's get practical. For someone listening who's just starting out, what's the absolute first step the guide recommends?
Build that contingency fund, an emergency fund. Aim for 6 to 12 months worth of essential living expenses. Some might even go for 24 months, depending on their situation and comfort level. Keep it somewhere safe and easy to access, like a liquid mutual fund. And remember, this is only for real emergencies. Job loss, medical bills, not for a vacation or a new gadget.
Right, emergency only. Got it.
Yeah.
And what about debt? The guy talks about a debt-to-income ratio. What's that about?
Yeah, the DTI. It's your total monthly debt payments like loan EMIs, credit card minimums divided by your gross monthly income. Ideally, you want that ratio below 30%. If you're carrying too much debt, the advice is clear. Stop adding more liabilities. Get a handle on your cash flow, make a budget, and really focus on paying down the debt with the highest interest rate first. That usually saves you the most money.
Okay, that makes sense. But what if you get some extra cash? Is it always smart to just throw it at prepaying a loan?
Not necessarily. This is where opportunity cost comes in. You have to weigh your options. If you could potentially invest that extra money and earn a return higher than the interest rate on your loan, well, mathematically, investing might be better.
So you might make more by investing than you save by prepaying.
Potentially, yes. Of course, there's a psychological benefit to being debt-free, which is valid. But purely financially, you need to compare the loan rate to potential investment returns.
Okay, so wrapping this all up, what's the big picture takeaway for our listeners navigating their own financial journey?
I think it boils down to this. Investing isn't just some abstract thing about making money. It's about making your money work for you. It's about securing your future goals by understanding yourself, your risk, planning strategically, and managing things like debt smartly.
Yeah, this deep dive really highlights how understanding concepts like compounding, inflation, and planning based on where you are in life can genuinely change your financial future. So as you think about everything we've discussed, here's something to chew on. How might really understanding your own personal cost of waiting change the financial steps you take? Maybe even starting today.